All right, well, we're back with another and perhaps special edition of the Emerald Financial Group podcast. It has been a while, and I'm here joined by Michael Cornebs. G'day, Michael.
G'day, Sam. How you going?
Yeah, going well. So it has been a long time between drinks, shall we say. Yeah. And we thought we'd do a sort of special edition of the podcast because we are experiencing pretty special market conditions.
We certainly are. The market keeps on going up. Is it possible that it'll ever go down again?
Yeah, well, I mean, looking at most metrics, it's perhaps the most bullish market ever. If you want to look at, fundamental valuations or earnings-based valuations, it's the most expensive market for the Australian share market ever. US is probably about on par as the dot-com bubble in 2000, 2001.
Certainly is.
Just from a whole global perspective, and not just equities perhaps, but other markets as well.
I was here for the dot-com bubble back in late 90s, early 2000s, and PE's got stretched beyond belief, and the US equity markets outperformed most other segments. And do you think it feels a bit the same with AI at the moment?
I think it's definitely possible. You look back at what was going on back then, and you see the rush to buy, the shovels and the picks, and Cisco Systems gets brought up to ridiculous valuations, as do the infrastructure builders and things like that. Arguably we're seeing a similar thing with the semiconductor producers.
It feels that we're buying into the same hype as a dot-com bubble. AI is going to solve all our problems. The thing is, there are how many different AI configurations out there, permutations, who's making money?
Yep.
What they're good at is raising money and spending money, but like the market buying eyeballs back in the late 99, we're looking for the magic solution AI will provide.
Yep, exactly right. And as I sort of tell our clients, at least in my Tuesday webcast, our members, AI is perhaps increasing the revenues and earnings of semiconductor makers now, but will it have that flow-on effect to all these other businesses that the analysts are saying? So in 2026, are we going to see, all the banks X amount more profitable because of AI? Are we going to see,
correct,
every company on the market more profitable because of AI? Eventually, it probably will come, but similar to the dot-com bubble, it's not going to be, I don't think, as quick.
So the promise of the dot-com came decades later.
Yep.
And the promise of AI will probably be a fair way down the path.
Exactly right. No one's doubting how effective the internet has been at
Correct.
Increasing earnings, but even with perhaps the greatest invention of possibly all time, things still bubbled to extreme valuations before it was sort of realized.
And a lot of money is going to get burnt.
Mm-hmm.
A lot of promises going to be made, and a lot of share prices will go down.
Yep, and I don't disagree at all.
You're also seeing some cracks in the US trying to block China from progressing in the chip market.
Mm-hmm.
But China's made a lot of progress circumventing the restrictions of the US.
Yep.
And I think you get the feeling the US is going, maybe our sanctions are not working in regards to chips, let alone any monetary sanctions they have on Russia. But China is making a very big effort to create their own leading chip makers.
Yeah, absolutely. And I suspect they will catch up pretty quickly. A lot of the research is out there. I think we've seen some of the lithography companies start to see their business reduced, and I suspect it'll be because of alternatives coming out of China and things like that.
And the promise of the EV vehicles, the battery technology, it seems to have stalled in terms of the promise, the solution for reversing the carbon of the world. And I think you always get a feeling the great idea,
mm-hmm.
but I don't think they're going to reach their targets.
No, and I think in terms of what they haven't been able to increase, things like the specific energy density of the batteries, the number of charging cycles they can go through at sort of high charging speeds. And, as a result, they can't really compete for many people with petrol vehicles.
Yeah, exactly. And I think everybody talks about range anxiety. You really can't miss that point. Somebody like myself who rides motorbikes, I can't see an electric bike out there without much more of a 150 kilometre range. That wouldn't suit my needs. I think if you're driving a car, you want to go from here to the snow or here to Sydney. The range anxiety is really scary. And then you have situations in the US where Tesla's finding that a lot of people are cutting the charging cables off the charging stations.
The copper,
for the copper. So they're facing all these new challenges. And Tesla, I think, is trying to progress wireless charging, which might resolve that particular issues. But it seems to be a lot of hurdles in front of us.
Yeah, absolutely. But just going back to the global market rally in just about every market, one thing we did want to touch on was where the money is coming from.
Yeah, correct.
I think beforehand, before we had this discussion, you sort of said we're in, I don't want to put words in your mouth, but perhaps the opposite of a liquidity crisis.
At the moment, it is clearly a mountain of liquidity in the market. Money is looking for a home, and it's quite clear. I find when you're having your barbecues and your parties, we talk about a lot of parts of the economy are doing a very tough. Renters, young people, students. There's a lot of cracks out there for the people with less money in their pocket. But at the end of the day, as you said, the record earnings, share markets is at record level, as almost a complete opposite of what the average person is feeling.
Yep.
And I think we'd all agree we've got high inflation, we've got shrinkflation, rents are going up, mortgage rates are high. You have all that negative news, but the market's going up. And I think there are a lot of people in the investment community who just believe in the power of liquidity. And there is liquidity out there. The US back in the Obama days and the Bush days, we were looking at 500, 600 billion a year deficits. Trump got it up to, I think, around 800 to a trillion. Don't quote me on those numbers. I just had a look at the figures this morning, and they're approaching a $2 trillion a year deficit. And people sort of yell and scream and say, oh, that's a terrible thing. But at the end of the day, betting against the ability of Americans to print money is a losing bet. They will continue to print money as long as their printing press will work. And the definition of their printing press is the ability of the world to absorb the US dollars, because the US is in deficit, $2 trillion. They need people to buy those treasury bonds, and at this stage they are. And given the fact the interest rates have increased from 0 to nearly 5% in the US, and in Australia, we're 4.35. Their interest bill for the year US interest bill is about $1 trillion. Again, that sounds bad, but it's not, because it's putting $2 trillion into the economy, into people's checkbooks. And what are they doing with it? They're spending it.
Yep.
Had a quick look at the Australian figures. The Australian government does publish monthly revenue and expenditures. Might be a month or two delayed, but you can pick it up. I picked up the July, August figures last week, and it just shows there's clear growth in tax receipts. There's no pullback. Clear growth in personal tax receipts, superannuation tax receipts, company tax receipts, luxury car tax receipts. The market, I believe, is bullish. And also in those numbers are the GST numbers, and again, they're healthy 4 or 5% increases on last year. So the economy is not pulling back. There is money out there, and that doesn't say people aren't doing it tough. But the people who've got money are spending money. How many doomsdayers have been talking about the property market crash? It doesn't happen. Now, there are reasons for it, but there's liquidity, there's immigration, and the government has a vested interest
in keeping it up,
in keeping that property market up. Friends of ours, they're trying to buy their first home, and the Victorian government gives you a 25% deposit. They go and buy a $950,000 home. Victorian government gives you a quarter of that, albeit they have to pay it back eventually. But let's face it, that underwrites the housing market. Another element that underwrites the housing market with all the freebies is throwing out there. And of course, China's trying to stimulate their economy as well.
Yep. So plenty of measures announced across the past month or so now, and they keep coming out with little bits. And I think that's probably a better way to do it than the sort of the traditional Western model of just announcing everything at once. And it forces, in many ways, the market to sort of do what you want it to do rather than have some big crazy initial reaction and then it's up to its own accord after that point. But more announcements on Friday in the form of giving loans to companies to buy back their own stock.
$5 billion a day, something silly like that.
I've always said I think the issue with the Chinese economy is more of structural issues rather than monetary settings or fiscal settings or fiscal spending. So I'm not sure this is a long-term solution to their problems. They need to move away from being the world's low-cost manufacturer, perhaps towards more domestic consumption.
Correct.
And maybe higher value manufacturing.
The Western economies, the private sector is about 70% of the economy, and in China it's about 30%. So they have a desperate need to get the local people to spend more into the economy. And I think they're taking steps in that regard.
I think they could be doing more. For me, I think what they're doing is trying to stimulate their existing industries rather than trying to trigger more of a transition. But I mean, we'll see. We'll see how see how it plays out. I do want to just go back to the we were talking about the U.S. government deficit, the record amounts of money printing. $2 trillion this year. The interest bill's up to $1 trillion. Government receipts, I think, around $5 trillion, something like that.
Yeah, I think it's 7 trillion, 5 trillion.
Yep.
Seven expenditure, 5.
5 receipt. Okay.
Could be wrong by a trillion, but we get the point.
Yeah. So it's a pretty big deficit as a proportion of the receipts.
No question. If you take their GDP of approximately 30 trillion a year, two, as you can understand, is 6-7% GDP as a percentage of GDP, which is a huge number.
It's a huge number, and so I think when you look at the formulas that calculate aggregate demand or GDP growth, it's very hard for it to dip down below zero when the government is contributing.
It can't happen.
Yeah,
it can't happen.
And so all the recessionistas, I think perhaps what they're missing is sort of this economy is being propped up by the.
And I do think a lot of the financial media, they need the headline.
Yep. And
a lot of them love the headline. Gold's going to 5-10 grand, and everything else is going to collapse and go and buy Bitcoin. And I think a lot of there could have been a bit of a widowmaker trade for the last 10 years, and I don't want to get in that discussion. But
a lot of people, another podcast entirely.
Look, I think everybody has an opinion, and we know about everybody having an opinion. The thing is that the US market, I just checked, is up 36% for the year. Did similar numbers last year. Do you believe it can do it again next year?
Personally, I think the biggest risk, and it's the risk for the US dollar, is that US bond investors start demanding higher yields. And they go, well, 3/4 of all US dollars have been created in the last 4 years. If you're going to pay me back in 10 years' time, you're going to need to give me, 2 to 1, 3 to 1, a greater number than they're offering now.
But that old joke that if I owe the bank $1 million, I've got a problem. if I owe the bank $100 million, they've got a problem. I think the world's got a problem, and we keep reading about what can the BRICS, Brazil, Russia, India, China, Saudi Arabia, what are they able to come up with an alternate currency? And from what I can see, they don't particularly trust each other.
No, they don't.
That might be a bit of an overstatement.
No,
but they haven't come out with a currency or a basket of currencies or a gold base or an oil based. But I think they are making good inroads into forming a wide community of people who want to be members of BRICS. The smaller countries, obviously. Mm-hmm. I think there's two numbers out there. I think the US dollar is still involved in 80-90% of world transactions, but that's a settlement number. But in terms of what assets people hold, I think that's people are holding it 60% US. And unless a stable alternative can be put forward, that's convertible, that's liquid, there's some promise that you can get your money back. But that, I think, is a long path to make.
Yeah, I think so too, but I still think there's a fair chance we see people start demanding higher yields on US dollars, especially if, obviously we've seen consumer price inflation start to slow, but risk asset price inflation hasn't slowed. I think the signs of currency devaluation are there, and I think, after the rate cut, we've seen yields just start pushing right back up.
But we use the word currency devaluation, but it's really the worst, the least worst person we're talking about, because the Britain's got a problem, Europe's got a problem, so devalue, relatively speaking, if you're both falling off the cliff. Yeah,
well, not devaluing relative to other currencies.
Yeah, that's right. Relative, somebody's got to come out there like the US dollar did, back in World War I, World War II. A better alternative had to come out.
Yeah. And
also, when we talk about US hegemony in the world, where they are the major currency, is they chose to take that mantle on. But with that being the top currency in the world, has a requirement for the US to run deficits. And they have to run deficits so the world can save money in the US dollars. So, and that's a bit of a quandary, that if you want to be the top number one in the world, you have to run deficits to allow countries to have savings. Now, I don't think China wants to be the net.
No, and you could argue that that's been devastating for US manufacturing, for example, keeping their dollar otherwise stronger than it would have been.
Also maybe to be cynical, it's not hard to be cynical in this world, is that also suited the wealthier people in the US, where they could export jobs to cheaper countries, and they export the jobs, export the factories, the old cliche, and then they get rid of the jobs, rid of the factories, and then they go and buy what they were making in the US. They go and buy it and borrow the money to pay for it. It sounds like a wonderful equation. It sounds like the golden goose. But I think everybody's pointing to that tipping point.
Yep.
But I just don't think. I don't think it's
close. I don't think it's close at all.
No, not at all.
If we could bring it back to more current sort of, equity market conditions, I think there's, for me, probably three potential headwinds for the market going into the next year. You said, it's 36%, 2 years ago, 36% across the past year. Can it do it across the year moving forwards? The three headwinds that I see are, one, can earnings growth be maintained? Because the market isn't just pricing in strong earnings now, it's pricing in continued strong earnings. I think the second thing is, can we see interest rates keep being cut from here? Can the Fed keep cutting interest rates and keep lowering monetary policy? And I'm not convinced that that can happen, basically, because we've seen economic data come in much stronger than expected. We saw inflation come in much stronger than expected last month from a consumer price perspective. And obviously there's a lot of liquidity out there.
You touched on it before, I think, Sam, where you can lower the cash rate, but it's a 10-year yield you need to look at, because that's pricing a risk premium.
Yep.
To go out. I mean, you could either invest for 10 years and take the rate every 90 days, or you go and take the 10-year rate. So, yeah, sure, they can take the cash rate down, unless they do it Japan and do a yield curve manipulation on the 10-year. But I think you're saying, and I think I agree, that the 10-year can show some risk premium.
Yes, absolutely.
Yeah.
And I think that it's a pretty strong sign that after the first rate cut, it has started pushing back up. It's uninverted now from the 2 to the 10-year.
And the inflation numbers aren't looking as rosy
No.
as they did a few weeks back.
No, and I just wanted to very quickly say the third thing is there's a lot of unquantifiable political risk. We've seen the Middle East start to heat up. We've got the US presidential election next month.
And it's not a clean game.
No.
Because it almost looks like whoever gets in, there's going to be a lot of argument, which is political instability. And if the House and the Senate is split in the US, there'd be less chance for the administration to get legislation through on either side.
Yep.
And the sheer animosity between the two sides is, I haven't seen it in my years, and that's been
No, it's becoming, I think, increasingly divisive.
Yeah.
And
the Middle East is coming to a head, with the US proxy over there, Israel, and the Middle East, and there's a drift to like Saudi Arabia going towards the BRIC countries. Mm-hmm. So there's a lot of instability. There's no right and wrong.
No.
It's just instability.
Absolutely, and I think if you look at past economic crashes, a lot of them have occurred with spikes in the price of oil. And some of them have involved wars around Israel as well. I'm thinking of the 1973 war. And that triggered a market crash, but I'm sure there's other examples as well.
It certainly is. And I think, and we were chatting before, there was a couple of risks I see in the market. And I think the general thing is, given all the liquidity coming in the market, things are looking bullish and continue to look bullish. But I think it'll be you may want to call it a black swan event. I think it'll be an unknown, a shock. That'll change things. So a couple of points I brought up before to Sam was with liquidity in the market, people aren't doing as a rule. They're not doing asset selection. What they're doing is the super funds. They go and buy their ETFs. So when you use your super fund and you've selected, top 200 or growth, the ETF does not make a decision on how good the stock is they're buying. They don't care. If it's in the index, they're going to buy it. So then when you have a weight of money, of liquidity coming into the market, the ETFs are going to buy anything and everything as long as in the index, even if it's got a downgrade on it. So the pure investors are out there saying the problem is there is no price discovery out there anymore, or there's less price discovery. There's all this momentum into the market. Michael Green in the US is a great proponent of this, and if you look him up, he's got plenty to say on the subject. And you've got the S&P 500 on the other side, that organisation pushing the fact that ETFs are better than active investing. Now the problem is, and who's right, who's wrong? The problem is, as a momentum in a positive market buys everything, if a black swan comes along and people want to get out, they'll just say, sell my ETF. Now, the fund manager is not going to look at the CBA share price. It ain't going to look at the CSL share price and see, is that a good sell? They're just going to sell everything, holus bolus, right? So, and that is everybody trying to get out.
Yeah, absolutely. I think, a great example of sort of what you're talking about with, basically the market becoming increasingly indexed, for want of a better term, is you can look at our own XJO top 200 and it can be up, 50 points on the futures. It can be tracking a move higher in the US. But then let's say something happens to the mining sector and it forces all the miners down. The banks and the other major sectors will rise an equivalent amount to those miners falling to keep our index 50 points higher.
Yes.
And it's just gotten sort of worse over time. It matters not really, what's going on for individual companies.
That's right. And how many clients have we had saying Commonwealth Bank can't go over 100, 110, 120, 130? It's a widowmaker trade.
It's crazy.
Because the flow of money's in there. And there's no rhyme or reason to it, and no amount of research, no amount of profit and loss research is going to tell you that you're right or wrong. Now, another interesting market out there, which I was reading about last week, is that in the fixed interest market, and I think the bond market, fixed interest market is at least 10 times, 20 times bigger than the equity market. A lot of people just don't know it or realise it. But what's happened is a lot of the banks are a lot more wary with the capital controls. So a lot of lending's moved to the private markets, the private illiquid markets. So a lot of big fund managers have moved into private credit. There's a lot been written on it at the moment. But another point to make is that if you're a fixed interest fund manager and you've made all these allocations to the fixed interest and the market changes and you want to re-weight, because the market's liquid, you can sell your range of fixed interest bonds that you want to sell. But if there's a preponderance of money going into the private sector, which is unlisted, unquoted, unlisted, and you're a bond manager with 50%, let's say, in listed bonds and 50% in unlisted, not quoted bonds, and you have to make a 20% adjustment to your portfolio holdings, the only thing you're going to sell is the liquid stuff because you can't sell the off-market stuff. So there's also a liquidity risk in the fixed interest in the liquid market. And and maybe a long bow to draw, if you go back to 2007 and we all watched the movie, is that they were betting against the lowest stack in the mortgage bonds, but then somebody realised that if that stack goes, the AAA goes as well. So so I think a liquidity risk in the equity ETF market and in the private credit listed bond market is really apparent to me.
Absolutely, I don't disagree, and I think we've sort of spent quite a bit of time. So maybe we'll finish by saying some key things to watch for the next few months. You've got, as we touched on, the sort of Israel-Iran situation. Israel's probably expected to launch a retaliatory strike against Iran in the next couple of weeks. We've got the US presidential election coming up. Neither side is planning on decreasing the deficit. Both of their plans will increase the amount of money flowing into the system, and that may have other effects, as we touched on. And then looking past that, it's going to be about monetary policy and what the Fed does, if they can justify further rate cuts.
Yeah, we must keep an eye on the liquidity, and we'll see that in the deficit numbers. We see that into whether anybody in the new administration in the US tries to pull back the expenditure. We always say good luck on that one. The Middle East, there's always some talk of nuclear weapons, people trying to get hold of it. I think Ukraine used the word. It's coming up a couple of times. Will the US engage more? A la boots? Will they be boots on the ground? You got Ukraine feeling like it needs some more support. Israel. What will the US commitment to that area change and
Possibly.
Their involvement, and that could be a catalyst to more destabilisation?
Absolutely. I think if one of the candidates has potentially suggested they might not continue supporting Ukraine, if that's the case, does that embolden perhaps China and Taiwan or something like that?
Yeah. So a lot of flashpoints, and you just mentioned Taiwan again. Mm-hmm. The US will protect Taiwan. And the main resource in Taiwan is their chip manufacturing ability, as oil and energy is what the US wants over there. So these are the things that we can see destabilisation. You know, a lot of political issues in the UK, France, as well. You're seeing a lot of riots, a lot of protests. So, plenty of things can come up as a black swan.
Absolutely,
and probably will.
Yeah, and you know, going back, it just remains all about US liquidity. So. That's probably the number one thing to watch.
And that's the one we'll be keeping an eye on. We'll be keeping an eye on the US Fed publishes daily CCC credit ratings on the percentage points, the triple Bs to Bs, all those we look at it daily. And at this stage, it's at the credit spread's at an all-time high. But if we start seeing those blow out, we'll be trying to trade it.
Yep, absolutely. So we will wrap it up there for this week, or for this edition, I should say.
Thank you, Sam.
Thank you, Mike. And hopefully you guys enjoyed. If you are still watching, click subscribe, click like, leave us a comment, and we'll see you next time.
Thank you very much.